All right, guys, welcome to the show. We are remote this week. I'm in Never Never Land, and Jerry's in somewhere else land.
Perfect. Got to be flexible, adaptable, overcome, and all that.
Yeah, and play with technology a lot. Every time we do this, nothing changes and everything goes wrong.
Yep.
But we got it figured out. And I'm using this funny mic that we don't ever use anymore. So if I go in and out, you don't want to hear me anyway. Just listen to Jerry. He's got all the important stuff to say.
You can't even see my mic this time. Hopefully you can hear me all right. And
Yeah,
we will be good to go.
He's got the little fancy mic on where he doesn't have to wear a headset like me. All right, man, take it off. Tell us what's going on.
All right. So yeah, it's been another week. So let's just get into it. TSP Weekly Podcast, 18 May 2025. So we're going to take a look at what happened this week. Trade negotiations with China. The big elephant in the room, which is not trade negotiations. Then the bonus chart is going to be the very long-term chart of the S&P 500. And then the TSP Fund charts. So this week's economic news. So Monday, the big announcement was an initial trade and tariff deal with China that happened over the weekend with the Treasury Secretary and the Chinese delegation in Geneva. Treasury Secretary came out and said they had a really constructive meeting. Nothing finalized, but very constructive. And the market really liked that. Was up 3.26% on Monday. Tuesday, we get the CPI. So the inflation numbers up 0.2 versus falling 0.1 in March. So month over month, we were up a little bit in inflation. Year over year, it actually fell 0.1% from 2.3 versus 2.4 this time last year. So CPI inflation basically sticky, right? S&P was up 0.72%. Wednesday, we get the 30-year mortgage rate up a little bit, not a whole lot, 6.86% versus 6.84% last week. New applications rose 1.1% after rising 11% last week. And then S&P 500 was up 0.1% on Wednesday. And then Thursday, we had Walmart earnings. Sent the stock down over 4% early in the day. And then by the end of Thursday, recovered to being only down 0.5%. The initial jobless claims came in were 229,000, same as last week at 229,000. The 4-week average rose slightly to 230,000 from 227,000. So, employment is still hanging in there. S&P was up 0.41%. And then on Friday, we had Michigan consumer sentiment and inflation expectations, which seemingly didn't do much for the market because that came out about 8:30 on Friday morning, and the market's pretty much flat at about 11 o'clock on Friday morning. But this is the headline from Walmart. Walmart becomes the biggest retailer yet to pass through tariff price increases, meaning pass it through to the consumers. So the company plans to raise prices this month and early this summer, and other retailers are likely to follow. So even though there are trade negotiations going on and they're not going to be the huge percentages, especially in China, prices are still going to go up because we still have that 10% across the board tariff plus, some from other countries. So prices are certainly going to go up this summer, and Walmart is kind of the bellwether for that. And if they're trying to pass it on to the consumer rather than eat it themselves, we're going to see higher prices. Okay, so the trade negotiations with China was definitely the big thing. So as of last weekend, U.S. and China entered a 90-day pause, to the ongoing trade dispute. So still we're back to this 90-day pause, which the clock began again last weekend. But in the meantime, it marked a significant tariff reduction on both sides. So the development follows a series of tariff escalations and policy reviews aimed to address longstanding trade imbalances and unfair practices. Tariff reductions. So last weekend, the U.S. reduced tariffs on Chinese imports from 145% to 30%, while China lowered its tariffs on U.S. goods from 125% to 10%. Mutual agreement aims to alleviate tensions and provide a window for further negotiations. So you kind of got to take that in perspective. Going into 2025, right? So forget about it. So everything before we started this whole new tariff thing, the tariffs on China at the time were 19% on average. They're different for different products, but on average they were 19%. So now, we went up to 145%. Now we're down to 30%. So we're still quite a bit higher than where they were coming into 2025, which means more revenue for the U.S., which is good. The 4-year review. So September 24, the U.S. Trade Representative finalized modifications to the tariffs over statutory 4-year review. The review led to increased tariffs on several Chinese imports, including EVs, semiconductors, critical minerals, to counteract China's unfair trade practices. So current negotiations and objectives. So during the pause, the idea is to resolve key issues, right? From our perspective, it's intellectual property rights, forced technology transfers, and market access barriers. Potential outcomes, right? We're on this 90-day pause. So obviously the markets really like that. But the first possibility is a comprehensive trade agreement, right? That would be the best thing we could do. If we have successful negotiations, a formal agreement could solidify the reduced tariff rates and establish mechanisms for ongoing economic cooperation. If we don't get to that, we have some kind of extension of the truce, right? So the 90-day pause maybe extends. Should more time be needed, both parties might agree to extend the tariff pause and continue negotiations without escalating trade tensions. And then the worst case scenario is a reinstatement of the tariffs. So if over the course of the negotiations, there's a failure to reach agreement, could lead to the reimposition of the tariffs at 145%, potentially reigniting the trade conflict and impacting global markets. So we're not out of the woods yet. We have this 90-day pause, and we'll see what happens over the course of that 90 days. All right. So the big elephant in the room, everybody's focused on trade and international trade and the tariffs, but there's a good handful of things that are going to be really important going into the end of this year. And one of the big ones is our debt and our ability to pay it. So this is a chart of the 10-year Treasury yield. Okay, so imagine this as a credit card. The yield, this is the chart of the yield. Okay, it's the interest rate that you're paying on that credit card. So it's the 10-year Treasury bond yield. Back here in 1963, it was about 4%. Okay. From 63 to 81, it went up to 16%. Right? So imagine your credit card interest rate goes from 4% to 16%. That's 4 times as much. So your monthly payment, if you're only making interest payment, your monthly payment goes up four times, right? Then from 1981 to 2020, it dropped all the way down to 0.5%. So over those 40 years, the interest rate that you had to pay on your credit card declined to 0.5%. So now this is the debt that you actually have on your credit card, and it's basically the federal government's credit card. So what happens when we get in trouble, or we want to just start investing more? We want to borrow more for whatever reason. When interest rates start coming down, right? It's a good time to borrow because you're borrowing cheaper, right? That's what everybody would think. You're borrowing cheaper, and so you can see here in 1982, that's where we begin the first real big uptick in increasing the federal debt. Okay. It's also the time that the stock market broke out, because as the government was borrowing more, right, more money's going into circulation, interest rates are coming down, but our debt begins to rise pretty dramatically. Okay. We're at a trillion here, and it doubles to there, and then it doubles again to 4 trillion, right? So it's going up pretty quick, even though the line at 1982 doesn't look like it's that steep. Okay, so rates keep coming down. Every time we have a problem, like 2000 right here was the top of the tech bubble, we borrow more money, right, to help the economy, and the rate of debt starts going higher. Okay, it's not so bad because interest rates are still in a decline. So the rate you're paying for the amount you're borrowing continues to decline. But we kept on borrowing, right? And now we're up here at 36.2 trillion. Okay, so that's what our debt is. The problem is now the interest rate on the debt has gone from 0.5% to where it is right now at 4.53%. So whatever we were paying, we were paying 0.5% on 28 trillion in 2020. Now we're paying 4.3%, which is a huge percentage move up, right? From 0.5%, and it's on 36 trillion. And of course, we don't have the money for that, right? So we just, it adds to the deficit. All right. So that's kind of that's where we are. But what matters actually is whether or not we can afford to pay it. Okay. So this is the debt to GDP. Okay. And this is the interest rate, 10-year yield. So this big spike up, we're borrowing for World War II. Okay. 1940 to 1945. This is all the borrowing we were doing for World War II. After the war ends, our productivity is really high. So our debt to GDP is basically, say, your salary, right? It's the federal salary. So if we get more productive, we can continue to borrow more. But if we continue to get more productive than we're borrowing, this line comes down, right? So our borrowing as a percentage of GDP is the value of how much of how we can pay it back. So if you make $100,000 a year and you have $1,000 in credit card debt, it's no big deal, right? If you double that and you have $2,000 in credit card debt, it's not that big a deal. But if you make $100,000 a year and you have $100,000 in credit card debt, it's kind of a big deal, right? Now your debt is 100% of your salary. And so we were up here at 124%. This at World War II, we were up here at 115% of our debt versus GDP. Okay. And the interest that we had to pay was really low. So now where we are is we're up to 124% of our GDP. Right? So we're 25% higher than 100% of our income. But the interest rate that we have to pay on that has gone up a lot. Okay, now it's 4.57%. So the rate is going up, and our debt to GDP is also going up, right? It's flattened here in the past few years. But unless we get either super productive or stop borrowing money, we're in trouble. And that's the problem with rates right now. And that's why the administration wants rates to come down. Because if they don't come down, this number keeps going up because we have to borrow to pay it. A lot of that is going to come to a head this year because of that 36 trillion that we have, a little over 9 trillion has to get rolled over this year. And so if it gets rolled over, at interest rates up here somewhere, it's going to add big time to the federal deficit. So that is definitely one of the big elephants in the room. And part of it is playing out right now in Congress with the budget resolution, what they're calling the the big beautiful bill. So it is going to be an exciting summer as far as that goes. All right. So the bonus chart, S&P 500. So this is just to give you guys some really long-term perspective, okay? This was the top in 1929. And this is the bottom at the Great Depression. So if you drew a trend line from the top in 1929 to the tech bubble top in 2000, we are right at that trend line right now. Okay, it's a monthly chart. So, on a daily basis, you don't see it very much, but we are basically bumping right up against that trend line right now. The other thing to kind of look at is the Fibonacci extension of this move from 1929 to the bottom in 1934. So if we do the Fibonacci extension of this move, the 1.618 gets us to right here, and we had all kinds of resistance here. That was the lost decade in the 70s. Okay, so that was about a 10-year time period. This was a 50% decline in the market. About a 10-year period where it couldn't get above resistance at that 1618 level. So it churned there for 10 years and then broke out to the upside. The next Fibonacci level is 2618. It broke right through that 2618, right? Peaked and then rolled over and found support at it at the low in 2003 and then again at the low in 2009. Okay, so the Fibonacci extension levels are important. The next one is the 3.618. And that just so happens to basically intersect this trend line and where we are right now. So there's no guarantees. Can the market just blow through all of this and keep on going? I mean, in the realm of possibility, that's possible. But on a long-term basis, you should expect some kind of resistance where we are right now. And again, it's a monthly chart. It's a very long-term chart. So it's to say that things could get really, really choppy. Could we get something like what happened here in the 70s? Or could we get something like what happened here back in the early 2000s? Yes, either one of those are possible. All right, just for some very long-term perspective. All right, so TSP Fund charts. It was a really big week, right? Last week, we talked about how we hit resistance at that 20-week moving average line, which is the blue line. So for 2 weeks, we hit resistance right there at it, and then we gapped up this week. It was a really big gap up. We cleared the 50 line on relative strength. And if you look back on this chart, every time you get, well, it's a weekly chart, so we're not seeing it that clearly, but every time you get above that 20-week moving average line, it tends to be the beginning of a decent rally, right? So this is a very bullish sign. Okay, as long as price and your risk is the 20-week moving average line. So as long as price stays above that blue line, the trend is up, and you're in good shape. S Fund also had a big week, right? Came down in much more of a straight line than the C Fund did, really. And it also reversed and came back up in a straight line. That's not really healthy market action. You'd much rather see kind of even this run up in 2020 into 2021 was slower than this. The past 4 weeks has gone straight up. So we'll see. There's going to be a pullback at some point. Ideally, the pullback doesn't take us below that 20-week moving average line. Because if it doesn't and we get support there, that would be a great entry point if you're trying to not chase the market as it is. iFund, it's even more gone straight up since its bottom in early April. In the newsletter this weekend, I'm talking about the iFund. It's if you did a long-term trend chart of the ratio of the C Fund versus the iFund, going all the way back to 2008, the ratio of the C versus the iFund peaked, and it's been in a decline ever since. And right now, that ratio is right on the downsloping trend line. So if we get some kind of pullback in the iFund and it explodes to the upside, it's going to be really good for international stocks, not so great for US stocks. But we will worry about that when we get there. And then the F Fund really continues to be the important one as far as the economy goes, because when the F Fund goes down, it means interest rates are going up. And if interest rates go up, it's the problem with the debt that we were talking about before. So we'll see. One thing I wanted to point out on this chart, these are the actual TSP numbers, and the TSP includes dividends. So when you're looking at these charts that we built them so that you guys could have the same numbers as what it says on tsp.gov. The problem is when you're analyzing the charts, you don't want to analyze the dividend adjusted charts because it gives you false readings. This is the actual price, which is great. This is the actual chart, but the index that the F fund tracks on a day-to-day basis is the aggregate bond index. And that chart looks like this. So you have a much less, this is basically a flat consolidation channel, right? As opposed to this, which is sloping upward at a much more bullish looking angle. But in reality, the index is not sloping up like that. This is the actual index. And it looks like we have a left shoulder ahead, a right shoulder. And if we break this neckline and rates get down here, or the price of the F fund gets down here, price continues lower. That means rates are going higher. And if that happens, it's going to be a really exciting summer. So all these things kind of interact. And then at the end of the day, of course, the G fund is always going up and to the right. Yeah. Questions?
A lot to think about this week, guys. Now is not the time to take your eyes off the ball. If you're invested in the TSP, you need to be paying attention to what's going on. It's the only way you can manage it. Don't get your advice from Facebook or Instagram unless it's ours, of course. But no, I mean, just you need to be paying attention to the market. You don't have to do it every day. You can do it, once a week, and it'll be fine. If you guys are tracking our newsletters, you have all the information you need. If you're not, check out our website. It's growmytsp.com. If you have any questions about anything you've seen today, you can put them in the comment section wherever you find the video. If there's no comment section, just shoot us an email, support@growmytsp.com. All right, guys, hope you have a great week, and we will see you guys later. Take care.
All right. See ya.
Bingo.